Hi folks, welcome back to this third video on question 2, which is really an optional lesson for you guys. But just in case you wanted to be able to calculate the ending consolidated balances for retained earnings and non-controlling interest, here's the way you could do it. You can actually start first of all with consolidated retained earnings at the end of the year by starting with the retained earnings balances at the end of that same year for which you're calculating the consolidated balance for each separate entity. So it's kind of similar to the way we calculated the opening balance of consolidated retained earnings by starting with the opening balance of each separate entity's retained earnings. Only this time we're going to start with the ending balances. So here for the parent we have 161,000. How'd we get it? Well, if you look back at the question, we know we had retained earnings at the end of year 5, which included the opening balance of retained earnings at the beginning of the year. And then they deducted any dividends that were charged during the year. All we're doing here is adding in the income during year 5 that wasn't in there in the question. So we're going to get 161. But now don't forget, during year 5, there was profit in ending inventory of the ending inventory sitting in the subs inventory that the parent had sold it, right? So the idea was the parent booked the profit, and the profit sitting in ending inventory and that profit that was booked by the parent was $1,200 after tax. That needs to be deducted because it's part of this retained earnings, 101,000. So if you need to refresh your memory on that, go back to where you did your intercompany profit analysis way back here. Ending inventory, parent selling, right? The sub had 5,000 of that inventory that it bought from the parent that was packing 40% profit. So before tax profit was 2,000, after tax was 1,200. That profit after tax was booked by the seller in year 5. But because that 5,000 that's holding that after tax profit was not yet sold outside to a third party at the end of year 5, that's profit that the consolidated entity can't take in. Separate entity parents, fine, no problem, but from a consolidated perspective it can't be recognized until it's sold outside to a third party. So what we're going to do here when we calculate the ending balance is we're going to reduce it. So we get an adjusted retained earnings balance for the parent of 159.8. Do the same thing over in the sub side. Start with its ending balance of retained earnings, which again will include the net income that the sub earned during year 5. So it has the retained earnings at the beginning plus the income less the dividends, so it's going to be 82,000. We know that at the date the sub became related to the parent, the sub already earned 20,000 on its own. So we're only interested in the retained earnings that the sub earned post-acquisition or since it's been related to the parent, which is 62,000. Now we have to adjust the sub's adjusted retained earnings post-acquisition for what three amounts? First of all, the amortization of the patents. Remember we said earlier that's cumulative, right? So, but now that we're at the end of year 5, it's not only going to include the amortization of the patent, of the acquisition differential related to patents for the first 4 years, years 1 to 4, it's also going to include the year 5 amount, which is 4,000 because we're at the end of year 5, and that amount would have been amortized in year 5. Don't forget our beautiful land gain here. Why are we eliminating that? Because the land is not yet sold outside by the parent to a third party. The parent is holding the land, right? Because the sub sold it to them, but they haven't yet sold it outside. So don't forget, the profit that the sub earned on it is sitting in its retained earnings, right? So that 62,000 is holding that $6,000 after-tax land gain because separate entity, when the sub booked that gain, they closed it out to retained earnings. So it's in that 62,000. So it has to come out. We can't legitimately book it in that ending balance of retained earnings from a consolidated perspective until it's sold outside. And just as we had up here profit and ending inventory that the parent had booked, we now have profit and ending inventory that the sub booked. So if we go back up here to the intercompany profit analysis that we did much earlier on, there it is, ending inventory, sub selling. Sub booked that profit of $4,800 after tax. Problem is, the parent has not yet unloaded the $20,000 in inventory that holds that after tax profit. So therefore, we need to make sure that it gets eliminated, and it can get recognized when it's sold outside. But for now, we have these deductions to make from the subs post-acquisition retained earnings. So it's going to be 31,200, which is the post-acquisition adjusted retained earnings of the sub. Parent takes its share at 90%, which is $28,080, and we get consolidated retained earnings, which is exactly the same as we saw in the consolidated statement of changes in shareholders' equity of $187,880. So if we go back here, we got the same number, right? So we know we did it right. Now let's see if we can calculate 13,120 as the consolidated balance for our NCI at the end of year 5. So if we go here, we're going to use the shareholders' equity of the sub at the end of year 5, which is what? Common shares 60,000, but don't forget, we know that the retained earnings is 82,000, right? So we use that to get the ending book value of the sub, plus any unamortized acquisition differential, that's 0. Oh, I guess I should go back up here, first of all. So scratch that last thought on the unamortized acquisition differential. I forgot to adjust the retained earnings. Why do I have to adjust it? Because from a consolidated perspective, we already said that the retained earnings of the sub is booking the land gain and the profit. That's the profit that the sub booked when it sold intercompany to the parent and inventory in year 5. Notice that when we calculated this balance, right, we had to eliminate this profit right here because that's profit that the sub would have been booking, right? It's part of this 82,000. So we're only going to adjust out any of the profits that we can't recognize from a consolidated perspective that the sub booked, right? And that's the land gain, and that's the intercompany profit that was sitting in the parent's ending inventory based on the sale it made to the sub. Right? So therefore, that's going to be adjustments of $10,800. So when we remove that from the $142,000, we're going to get adjusted shareholders' equity of $131,200. Now we said that it's that book value of the sub, which is the shareholders' equity, the book value of net assets, right? Plus the unamortized acquisition differential. But don't forget, by the time you get to year 5, that acquisition differential of $20,000 has been fully amortized, right? It went from year 1 to year 5 inclusive because the patent had a 5-year life. So it's been fully amortized. So now we're going to get $131,200 as the book value of net assets of the sub, adjusted for any of these amounts that we can't take into our consolidated balances, and we're going to take 10% of it. So we'll get $13,120 is our ending balance of NCI at the end of year 5. And if you went back to check that up against your statement of changes in shareholders' equity, you'd get the same thing. So therefore, this concludes our proof that the ending balance of non-controlling interest at the end of year 5 and the ending balance of consolidated retained earnings at the end of year 5 is the same if we had calculated using the separate entity amounts as it is if we calculated it through the using the opening amounts and adjusting to get to the ending amounts by doing the statement of changes in equity consolidated. So hopefully this little video has helped, and good luck with your studies.